it's very, very hard to get ahead, or accumulate assets or get wealthy, get ready for retirement if you're not in the habit of saving money. So the rule of thumb is you need to set aside 6 to 12 months of your monthly living expenses in an account. This is not an investment account. You don't try to maximize gains on this account. This is going into a savings or checking account, and then you just leave it alone. That's just one example, the power of depreciation. And then I have had another situation where I help a client with a IRS audit. Hi everyone, this is Hareesha from H&B Premier Tax and Accounting LLC. I'm a CPA here in Long Island, New York. I work with a lot of small businesses and business owners, high net worth individuals, and also people that want to grow and build their wealth. So today I want to bring one important topic that most of you probably have thought but never made the time or to discuss with your accountant or financial advisor. So these are 5 things that just because you didn't talk to them and you didn't pay attention, that cost you thousands of dollars in the past, and then also will cost you thousands of dollars in the future, if not more. So what are these 5 things? So I'm going to have like major categories, like 5 items, and then I'll elaborate what I'm talking about under each one. Let's dive into it. Number one is growing your income. I see a lot of clients every year. So when I sit down with them to do their business accounting, finance, planning, or tax returns, annual reviews, a lot of opportunities. I get to see my clients, discuss with them about their finances. So I made it a point to discuss their income trajectory. So what income they had in the previous year, what income they're having this year, and then also are they going to grow their income year after year. So if I see someone's income is going down, or his income is at the same place, I have the discussion with them. Why? Is there anything that they could do to increase their income? So how do they do that? So they could start if they're an employee of an organization, if they simply have a job, they could do the best job that they could do for their organization. And then if they work for a good organization, if they do good work, at the end of the year they will be rewarded. They will get a bonus, and then also they most probably will get a raise, right? So but what if you work for an organization that is not so generous, or doesn't recognize talent? Then there are many other options you could follow. You could get a second job, part-time job, or you could learn a skill that you increase your value in the marketplace. So you could take a course on any kind of business skills, right? You could take a course to be an office manager. You could take courses to improve your skills with technology, like or else if you have savings, if you have the ability to buy assets, you could create additional stream of income. For example, I was sitting down with a client. She has the resources, she has assets to buy a rental property. So my discussion with her was like, why don't you buy a rental property, so that way you could create additional income, so that will improve your income, right? Now so it's important, something that you have to pay attention. Most people kind of know their income, but if you don't pay attention, it will not grow. So that's why as the advisor, I always encourage people to pay attention to that, and then work on it. And also this is important if you're during your working life, right? If you're retired, it's a different story. Your goal may not be improving your income, but you might have to follow a different strategy. So what's next? Next, the discussion that you need to have with your accountant or financial advisor is growing your savings and investments. So this is very, very important. This goes along with growing your income, because I get to see what people, whether people are saving money or not saving money, right? So it's very, very hard to get ahead, or accumulate assets or get wealthy, get ready for retirement, if you're not in the habit of saving money. So if you're growing your income year after year, and then you're not increasing your expenses at the same rate, right? So you should have enough money left to save and invest. What's happening is a lot of the time people will grow their income year after year, but immediately they will take the additional income and then spend it or create additional bills, right? So encourage people to always look at things for their functional use, right? So if you have a car, right? What's the purpose of car? Purpose of car is for you to get from one place to the other, right? So if you have a car that's decent, looks nice, it's probably maybe 2-3 years old, you don't need to change it every 3 years, right? So if you get additional money, you have additional income, you don't need to go buy a brand new car again and spend all of that money, or increase your car payment every month. Instead of you could keep the same car, and then increase income you could direct towards your saving, right? So this is something I talk to a lot of my clients, and then I have these discussions every time I get a chance to sit down with them and have financial discussions. So how do you do that? So you could maximize your savings to your retirement plans. I did a whole video about if you put money into an IRA, how much wealth you will create over the years. So I'm going to click leave the link for that video, so you could go check it out. But one way to increase your savings and net worth or the investments is to put money into your retirement accounts, IRA, 401ks, 403bs, any kind of plan that your employer offers, right? So you want to take advantage of those plans, and then put money into those accounts. And then once you have that taken care of, next thing you want to do is you want to put money into an emergency account. What is an emergency account? Emergency account is a savings or checking account that you keep the money aside for an emergency, right? For if you have a car breakdown, or some major repair at your house, so you need to have some money set aside. You could handle those situations. What happens is most people, they don't save enough, they don't have an emergency account. If something goes wrong, or they need money for an emergency, they have to go into their credit cards, or they have to liquidate their investments, right? So instead of doing that, if you set up an emergency account, you when the need comes, you will have the money. You don't have to worry about it. So the rule of thumb is you need to set aside 6 to 12 months of your monthly living expenses in an account. This is not an investment account. You don't try to maximize gains on this account. This is going into a savings or checking account, and then you just leave it alone, right? So you have to have an emergency account. So if you have the financials to support your retirement savings and emergency account, next you want to go into other kind of investments, regular investments. You could set up a brokerage account, and then invest in the stock market, or else you could pick any area that you're comfortable with, like real estate, small businesses, any kind of area that you are comfortable with, that you make the investments, right? So the key is that how to do, and then you're comfortable with, because you don't want to go into the things that you don't know. That's the easiest way to get in trouble, and then lose a lot of money. All right, so that's the item 2. Now let's go to the item 3. So what's the other next thing that you need to have a discussion with your financial advisor and accountant. All right, let's talk about the third subject that you want to have a discussion with your accountant or financial advisor. That's maximizing your tax savings or your tax strategy, right? For all of us, for the most part, the largest bill that we will ever pay throughout our life is the taxes, because large portion of anybody's income goes towards taxes. So if you use the laws in the country or the in the tax code to maximize your tax savings, you will get so much ahead, right? So that's why you want to talk to your accountant and tax advisor about this kind of stuff, instead of going to them at the end of the year just to prepare a return. So what are the things that you could do to maximize your tax savings? Most people are cash basis taxpayers, which means if you don't get the income during the tax year, you don't pay taxes. So because of that, you could time your income to either year that you want to fall into, right? Let's say you have a transaction that's happening, that you could make it happen in 2020 or 2021, right? For example, if you're selling a house. Okay, so if the house sale is going to be subject to tax, right? So if the closing date is in December, or it's closed any date in December, you could postpone the closing date to January. So that way, any taxes that you would have to pay on that sale, you could postpone it 14 months. All right. So the same way, like any kind of business transaction. So if you have a business that pays taxes based on cash basis, so instead of if you have a big sale or big contract that you're going to sign and then get revenue in December, right? So you could actually talk to your customer and then plan that in the next year, and then match up with the your other expenses related to that project, right? Because otherwise what will happen is you'll collect the revenue, right? And then you will have to pay taxes on it, and then for that project your expenses will be in the next year. So cash basis taxpayers got to time this stuff and be careful, right? So then the same thing with the expenses, you could time your expenses. Now if you are a cash basis taxpayer and a cash basis tax paying business, so then if you pay your expenses, right, this year you incurred and paid, then only you could take a deduction. Otherwise you incur the expenses, meaning you have a bill but you don't pay it, you cannot take a tax deduction. So what else you could do? You could time your capital purchases. So let's say we are right now at the end of the year. So if you're going to buy equipments for your business, right? Let's say $10,000 worth of computers or any kind of equipment. Okay, let's say you're going to buy capital you're going to buy capital assets, right? So like machinery, equipment, vehicles, things like that. So and then you're going to do like improvements to your office space, the buildings, things like that. So if you're going to do that kind of stuff in early 2021 anyway, so you might as well do it in this year 2020, right? So that way you could take a deduction on this year. And also there's a thing called bonus depreciation and section 179 depreciation, which allows for a company to take the deduction for capital purchases 100% in the same year that they buy the assets. Like for example, if you buy $10,000 worth of computers, right, as long as you have enough income, you could take a 100% of section 179 depreciation on something like that. So meaning you could reduce your income by $10,000. Even if you don't have any income, you could take a bonus depreciation, 100% bonus depreciation on something like that. And then also you want to make sure that you provide details to your accountant about capital purchases. Because if you provide the details, so then they could take a deduction on it. But if you don't provide the details, they don't know. And then also, even if you do provide the details, if you're now working with like real good professional accountant, then they might miss it. I have seen situations where when I, took a new client, the previous accountant did not take, the depreciation. This was a large tax return, a lot of income involved. So the depreciation was almost 250,000. So I talked to the client and I said, look, maybe I might be able to am in and get you a refund, right? So he said, okay, I want to do it. Go ahead. So which we did, and then after 4 months, the client got a refund up to 125,000, 100,000 from IRS, another $25,000 from New York State, which he was very, very happy. But that's just one example, the power of depreciation. And then I have had another situation where I help a client with the IRS audit. IRS came up with a bill for almost like $50,000. But I reviewed the returns and then I realized the previous accountant did not take the depreciation on rental properties, which increased the tax bill for the client. And then, I had the discussion with the IRS, agent, and then he agreed. And then, I saved thousands of dollars, for the client. So, that's, one thing you could do. And then you want to be mindful about that. What else? You could, if you're a real estate investor, you sell properties, right? There's a thing called 1031 exchange that you could do, meaning if you sell a property and then you have profits, from that sale, instead of paying taxes on that profit, you could, if you follow certain rules, and then you could set up a 1031 exchange fund. You could buy another property using the same money, and then until you sell that property, you don't have to pay taxes, and then you could keep doing that and then postpone taxes all the way till you pass away, and then and then you will never have to pay taxes on income like that, gains like that, right? The next thing that you could pay attention to is your itemized deduction. Most people don't take itemized deduction now because they automatically get a higher standard deduction, right? But if you come very close to the standard deduction, so then you got to pay real attention. For example, your charitable contribution. So I have some clients that gives a lot of money to charity. They give 10% of their income to charity. So they give like 15,000, 20,000 almost every year towards charity, right? So let's say if someone gives like 15,000 to charity, and then they have property taxes like another 7,000-8,000, so almost like 23,000, but still they are below the standard deduction limit. So that charitable donation is not giving them any kind of tax benefit. So what they could do is they could batch their itemized deductions to 1 year. For example, so instead of giving $15,000 charity to church this year and then again giving another 15,000 next year, so they could put away 30,000 in 1 year to donor advised fund, right? So what is a DFA? Donor advised fund is a brokerage account that you could set up with any kind of brokerage that you set aside money towards a charity purpose, right? You cannot take that money back, but it has to go to charity. But when you put the money into that account, you could take the deduction. So instead of taking a $15,000 deduction, now you could take $30,000 deduction in 1 year, and then you could take the itemized deduction this year, right? So the next year, you don't have to put anything into the donor advised fund because you already made the contribution in this year. But when you want to give the money to the church, you could take it from the donor advised fund and then give it to church. So church, would not know any difference. In your case, you would have gotten, taxable, deduction. Otherwise, would have gone to waste. So by doing this, it doesn't affect your church. It doesn't affect anybody. That you're just benefiting and you're saving money. So if you save money in taxes, you will have more money to give to charity. Otherwise, you would not have. So, and then also, if you have, if you're in a very high income tax bracket, you might want to pay attention to tax-free income sources, right? What are tax-free income? There are a lot of things, there are a lot of tax-free income, like triple tax-free municipal bonds. Like, if you are a New York resident, you buy New York municipal bonds, right? So then they're tax-free for the federal, state, and federal and state. So you don't have to pay any taxes. And then also, if you rent your house, for a very short period, less than 14 days a year. So that's something, tax free. There are like, a lot of things that, you could do that you don't have to, pay any taxes, right? So you got to, pay attention to, those kind of things so that you could, save in taxes. So bottom line is, um, all I want you to do is, have the discussion, right? So that way, at least you keep that in the front, so you will do something to take the advantage of the tax savings. Number 4 is proper protection, all right, for you, for your family, and then your asset. So this is something that I personally talk to a lot of my clients, because people don't think about these things unless someone bring it up to them. So number 1, if you are someone that has a family, and then people depend on you, you got to protect your income. So how do you protect your income? By having a life insurance. So I'm not a life insurance salesperson. I don't care where you get it from, as long as you have it. Okay, so because it's important, you don't want to leave your dependents, people depend on you, in trouble, just in case something happens to you, right? So life is so fragile, and if one thing we realize in 2020, that's it, right? So how fragile the life is. So you want to make sure you have life insurance. And then if you have loved ones, depending on their situation, you could decide whether you want to have the life insurance for them or not. But if you're the breadwinner, if you're making income, you want to have life insurance. The next, people need to have health insurance. It's surprising to me how some people will not have a health insurance policy, and then still they make income, they have decent income, because everybody thinks that I'm going to be fine, the bad things are not going to happen to me, right? But the truth of the matter is, we don't know. Just one medical bill is enough to wipe out someone's entire savings, because that's so ridiculous, high. So that's why it's very important that you need to have health insurance. And also, if you're a self-employed person, or if you have a business, you could purchase a policy through your business, and then you could pay towards the policy using pre-tax dollars. So you will get a tax benefit for the health insurance that you pay. And then you need to have, if you are a professional that you just work, and then entire income is depending on you, long-term disability insurance, and then also long-term care insurance, which will help you for situations like if you have to go to a nursing home, in terms of a disability, or a sickness, things like that. So those are when it's come to individual side, right, and family side. What about asset side? So when it's come to assets, you need to have proper insurance for all your assets, especially vehicles. You need to review if you have enough limits or not, because most people drive with state minimum limits, but if you get into an accident, those are not enough. And then I have a personal example, an experience where last year my wife met with an accident. Fortunately she was saved and nothing happened to her, but somebody else bystander on the road got hurt, and they sued originally 90,000, and then they found out that we have a policy that has large limits, then the claim went up to almost 250,000, and then they found out that we have the umbrella policy. Now they're suing us for almost 800,000, right? So the point is, thank God I had larger limits, and then also I had umbrella policy to cover the exposure. Otherwise I would be paying something out of the pocket if I just had the state minimums 50,000. So and then you need to have proper limits for your homeowners insurance, and then if you live close to water, you need to have flood coverage. And then once you have all these policies for each property or assets, then you need to have an umbrella policy. What is an umbrella policy? Umbrella policy is a policy that sits above all the other policies. Like, let's say you have an auto policy, right? So you get into an accident and hurt someone. So if your auto policy is not enough to cover the damages or the liabilities, your umbrella policy will kick in and then pick up the liability and then pay for the claims. If you're a professional working in a profession advising other people, you want to have proper licenses, and then also you want to have the professional liability insurance or E&O, errors and omission insurance. So if something goes wrong, right, so you will be protected and covered. The truth of the matter is something will always go wrong. All right. Then it's another thing that I talk to a lot of my clients is to get business continuity policy, right? So if for whatever reason, so if your business has to stop, so the policy will give some kind of support to continue your business, and then also credit insurance. So if you are selling a lot of things on credit, so then you might want to consider credit insurance. I have had clients that we advise them to get credit insurance, which they did, and then thank God during the pandemic some of their customers did not pay, but the credit insurance kicked in, and then end up paying almost like 300,000. So the clients were very, very happy. So something that every business owner wants to look into. All right, so that's number 4. Let's go to number 5. This is wealth planning or wealth transfer planning rather, and a legacy planning, right? What kind of legacy you want to leave. So one thing to one skill to earn money, another skill to keep the wealth, is another skill that you want to have to create generational wealth, right? So why that's important, because if you don't plan, if you don't put things in place, and then you don't talk to your attorneys, accountants, financial advisors about these kind of things, you will not be prepared in an event that you pass away, or somebody in your family pass away, to deal with these kind of things. And also the cost of not being prepared for these kind of things will be in the thousands, if not hundreds of thousands of dollars, right? What's the first thing that someone need to do? They have to set up a will, right? So what is a will? Will is something that you document in the event that you're passing, how you want your assets to be transferred to your heirs, your kids, your wife, your relatives, whatnot, right? So if you don't have a will, what's going to happen is your asset will go to probate. So the state will decide how the assets are going to be distributed. So it's very, very important you take time to set up a will, and then keep that with some trusted people, and then also get professional advice to set it up. You need to go to an attorney that could help you with that. So then you need to have healthcare proxies set up. What's a healthcare proxy? If you go into a coma, who has the authority, or who has who can make the decision to pull the plug that that they could let you go. And then what else? You want to check your beneficiaries on all your financial assets, like your life insurance policies, your bank accounts, your brokerage accounts, or any kind of accounts that let you put a beneficiary. You want to make sure that those beneficiaries are there, because what's going to happen is, if you're not careful and then you forget to update, your hard-earned assets will end up in somebody else's hand. I could tell you stories that things happen. I know one situation where one of my friends was the advice on this client. The client passed away, and she got a life insurance policy while she had a boyfriend, right? So she named the boyfriend as the beneficiary. But by the time her passing, the boyfriend was nowhere to be found, and then she never changed the beneficiary. So when she passed, the money, the death benefit of the life insurance policy went to the ex-boyfriend, and her kids did not get anything, right? But nobody could help with that, because she never bothered to change the beneficiary. So very sad. And also, if you inherit IRAs, right, it's very important, you talk to an accountant how to handle that. And then I know a situation where a couple had a child pass away, elderly couple, and they inherit a large amount of money through child's retirement account, right? They did not know what to do. They said, send us the money. So they got almost like more than $500,000, and then 1/3 of that went to just taxes, right? If they just talked to an accountant just to get some help, they would have saved more than like 100,000, 150,000 in taxes. So it's very, very important. And then also, if you are someone getting married at a later age in life, you're going into a marriage with a lot of assets, you might want to think about things like a prenup, or you want to be careful not to like commingle your assets, or combine your assets, because I have seen situations where people get into a marriage, and then they come to marriage with a house that they own, right? And then they pay the mortgage together, and then put the new spouse on the deed, right? And then after like many years, after some years, they get divorced, and then now they have to split that asset, right? So I'm not saying like not to trust your partner with your money, but that's something that you need to have a discussion and think about. And then also there are other situations that I have seen, like when people have wealth or money, they have kids that always depend on their parents' money to do crazy stuff. So you got to have discussions with your kids, and then make sure that your elderly kids don't take advantage of you, right? It's one thing to support a struggling child, but it's another thing that you're letting them be dependent on you, but not building their own financial future. And then also another thing that you got to pay attention to is step up in basis, right? What is step up in basis? Let's say John Smith owns a house, right, that he bought for 100,000, right? When he passes away, that house is after like 40 years worth like $1 million. Okay, so now when John Smith's kids inherit that house, they inherit that house at $1 million value, which means if their kids, if his kids turn around and sell that house for $1 million, they will not pay any taxes on that gain. So what some people do is, some people transfer their house to their kids without thinking of that. If John Smith transferred the house to the kids before he passed away, so kids will inherit his basis, meaning kids will inherit $100,000 basis of that house, and then kids turn around and then sell that house for $1 million, right? So they will have a $900,000 gain, and then they will pay taxes on that $900,000. So which is very important to pay attention to. So that's why, like when you do this kind of asset transfers, you always want to talk to an accountant. So that's it, folks. There are a lot of things. This is not like an all-inclusive list, but certain things that you need to talk to your accountant, advisor, and if you have any questions, feel free to reach out to us through comments, or through our website, Facebook page. Also, if you see the value in this kind of content, please remember to subscribe and give a thumbs up, and then that will help us tremendously to get this message out. I'm very passionate about helping people, seeing our clients grow, helping people become financially independent. That's our mission. So until I see you in the next video, have a great week. Take care of one another. Bye bye.